Okay. Hello, everyone. Welcome to this first edition of Tax Strategies Conversation with me, Dr. Lily Binglow. You're amazing. I'm very happy. Dance loving CPA. So excited to be doing this. To anyone who is streaming in from Facebook, from YouTube, or LinkedIn, thank you for making the time to hang out with me. I promise it's not going to be wasted. You hear me? It's not going to be wasted. It's going to be a lot of fun. I'm Dr. Lily Binglow. Like I said already, I am a licensed CPA. That's very important because we have CPAs that are not licensed. That means they're not up to date with what's happening. And I am licensed. I am also an adjunct professor at the MBA program at Regent University, and teaching just brings me so much joy. So I'm hoping that through this series, I can empower all the entrepreneurs, the business owners with enough information, with the right tools, right, to make informed decisions, to build successful and sustainable businesses. And so we can all win together. When you win, we all win, right? That's what it is when you think about community building and empowering each other. And so let me be that resource for you. I'm always happy to offer my time to teach, to enlighten, to bring you into information that can really transform your business, especially when it comes to the tax element of it. All right. So this is a 3 days, I call it a conference. Yes, 3 days conference, right? Because we'll be doing this every month and it's going to be for 3 days. I cannot wait for next month because it's Women's Month. And yeah, there's going to be some really interesting stuff. So for today, our theme is setting up for success. And the focus of today's conversation is understanding how businesses get taxed so you can choose the right business entity, right? Isn't that amazing? So if you've known me long enough, entrepreneurship is at the core of my being. It's like I was born for this, right? The path chose me. I didn't even have to choose it. I was like, you come, 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 come. You have the source and you have to help other entrepreneurs, drink that sauce too so we can all win. But taxes is crucial. Taxes is one of those things that as an entrepreneur you cannot avoid. And it doesn't matter where you are as a business owner in the world, unless the country doesn't need your money. But taxes is really crucial. And so for those who do businesses here in the US, even more important that you understand uh, uh, how the entity structure that you select impacts you tax wise. Because a lot of times when we have great ideas, we're ready to set up businesses, we just rush online, go to some website, sign in, create an LLC, right? But we don't think about the long term implications of what we're doing. And that's why it is my honor and hopefully my privilege to share some information that will help you as you choose the different business entities. So let's start, right? What does taxes even mean, right? Taxes is it's something that is levied on businesses, individuals, legal entities to pay their quota, right, of what is expected to build the economy, fund government expenditures, contribute to different funds, and things like that. So anyone who earns an income, especially here in the US, you're generally required to pay taxes. For business owners, when you start making a profit, you are required to pay taxes on your profits. Now, there are other taxes you would pay whether you made a profit or not, like payroll taxes if you have employees and things like that. But today's focus is on income taxes, and this is the taxes that you pay when you're making money in your business. All right, and so you do have to pay federal income tax and state income tax. So let's get to how businesses get taxed. Okay, before the average person becomes a business owner, they are an employee. When you're an employee, the one thing you never have to worry about is how this tax stuff works. Okay, you fill out a form W-4, you put the number of dependents you have, they do some calculations, and you just know, look, they take out taxes from your paycheck and you're good to go. Okay, your employer takes out federal income tax withholding from your income, right? And then they take out 50% of your social security and Medicare, and then they pay the other 50%. That's the benefit of working for somebody, because they get to pay that other 50% for you, which goes to fund your social security and your Medicare. Okay, so as an employee, when you work for someone, you just know by the time you get your check, they've taken out the taxes. So you work, you earn, right? You pay taxes, and then whatever is left, you spend it. Period. Simple life, right? Can't lose your mind. When you become a business owner, it's a whole different ball game. All right. Let me point out something here. If someone has never told you, the tax code was set up for two people predominantly: business owners and real estate investors. And what I mean by this is there are so many benefits of being a business owner or real estate investor if you have the right person to teach you how to leverage the tax code for you. Okay. Now, when you become a business owner, the way you get taxed is very different from the days when you were taxed as an employee. Okay. So, as a business owner now, you are responsible for that. And this is not just business owners. If you work for yourself, if you're a sole proprietor, if you're an independent contractor where a company pays you the full amount of money you make, you have the responsibility to pay your taxes. Now, here's the beauty: as a business owner, you normally earn money, right? You deduct everything that you had to spend in order to make that money, and you only pay taxes on what is left. Unlike the employee, where the employee had to pay taxes on their gross. So whatever they made, they had to have their income taxes taken from there. As a business owner, when you make money, you're able to deduct every expense that you incurred in order to make that money. And so whatever is left now as profit, that's the only amount that you pay taxes on. Now, how much taxes you pay and how that is going to be structured depends heavily on the type of entity structure, legal structure that you have selected for your business. Okay. So today I'm going to be walking you through the different legal entities. So that way you are aware when you decide to start a business, you know how this is going to impact you. So when you finally make that big decision of registering a business, you're very aware and you have clarity on what is going to work. Okay. So let's start off. What's a legal entity? A legal entity is just what it is. It's an entity that is legal to do business. So there are different types of legal entities. And let me just start by telling you, you looking at me right now, you are a legal entity, okay? You can start a business with your name, your social security, and you will be just fine. A legal entity is anyone who is legal to operate a business. They can borrow money, they can sell things, they can make money, they can sign contracts. That's a legal entity. Okay. So all the different business entities will also be covering, including you as the individual. You are a legal entity. So stay with me. Let's go through one after the other. Okay. I did make my notes so that I don't get excited and go all over the place. You guys know how much I love this stuff. I live and breathe this. Okay. I could talk like this for 1 hour unless you catch me and say, come back. Okay. So let's start with explaining one thing that you should always keep in mind. The entity structure that you choose is going to impact four major things, okay? The entity structure that you choose is going to impact, first, how you pay taxes. Pretty clear, right? Second, it's going to impact if you have any protection. So it's going to determine if you're protected or not, right? Which means if someone were to sue you, are they going to come for you and everything you have, or they can only come for what's in the business? Okay. The third thing is the type of entity structure you choose gets to impact or determine the ease with which you can raise funding. That's very important, business owners, because if you're going into a business where down the road you want to seek funding from angel investors, from the public, you want to avoid certain entity structures that do not give you that flexibility and freedom, or make it very complex for you to raise funds. I've seen it happen to a lot of people. Started out their business when I registered an LLC online, and then they're like, oh, we're looking for investors. And investors are like, nah, I'm not trying to be a partner. Okay, I want to be an investor. So it changes the ball game, and we'll be talking about that. The last thing is how easy it would be for you to exit that business or sell it. Okay. I always say you should have that end game or that end goal in mind when you're starting out. If you're setting up a business to pass on to your kids, you want to have clarity. If you're setting up the business to be able to sell, you want to have clarity. How you set up the business is going to impact all of these decisions. All right. So let's start with our first one. What is our first and easiest business structure? I mean, this is the one where you can roll out of bed and just start. Sole proprietorship. Okay. The sole proprietorship is someone who woke up one day, decided that they want to start a business. Here's the beauty. As a sole proprietor, especially here in the US, you don't even need to register a business or get an EIN. Your name and your social security are good enough. Your social security serves as a tax ID number. Okay. uh, the simplicity of sole proprietorship makes it really attractive for someone who is testing an idea. Okay, someone who is starting out, they have a great idea, but they're not sure if they're going to like it or if the marketplace is even going to welcome it. So they set out and they say, okay, I'm going to just start off as a sole proprietor. Easy, right? Now, when it comes to how sole proprietors get taxed, here's the interesting thing: the IRS doesn't have a tax code for you. So you and someone who got paid as a 1099 independent contractor pretty much gets taxed the same. You pay self-employment taxes, which is 15.3% on your profits. Okay. Now I need to explain that. When you are an employee and you work for someone, they pay half of your social security and Medicare and you pay the other half, right? Now, when you start working for yourself, now you are self-employed, you have to pay the full 15.3%. When you were working, you were only paying 7.65%. Then your employer was paying the other half on your behalf. But when you start working now for yourself, you are self-employed. So you have to pay the full 15.3%. Okay. That can be quite a lot, especially if you're making a significant amount of profit. One other interesting thing is that sole proprietors cannot really run payroll on themselves. You can't pay yourself. You can't run payroll on yourself because whatever you take home as profit is considered what you paid yourself. So please be mindful of that. If somebody tries to sell you a payroll program, let them know you're a sole proprietor and it makes no sense for you to run payroll on yourself. And this is why, because first, the IRS doesn't treat you and your business as separate from each other. And then second of all, why would you be running payroll, taking payroll taxes when you're already paying self-employment taxes on your profit? Makes no sense, right? And so sole proprietors file their taxes on what you call a Schedule C. And the Schedule C is attached to their personal taxes, okay? Because the IRS says you're disregarded. So that's how it is. Now, what's the risk with that? You guys remember some things I said? There's no protection. There's no liability protection, which means if you, in the course of doing your business, you messed around and hurt someone, they can sue you and everything you literally own. That's not good. So as a sole proprietor, you are exposing yourself, right, to a lot of liability, if I would say that. Another thing is, I mean, it's kind of hard to raise money, except you have rich family members and friends that want to invest into your business. Because if something goes wrong with you, the business is dead. Who's about to take that risk, right? So, as a sole proprietor, it can be challenging to raise money, and of course, even more challenging to pass on the business to anybody else without it being a functioning legal entity with some kind of protection. Okay, but that's it. Is it wrong? No. And why do I say it's not wrong? Because it serves for certain types of businesses. Like I said, if you're just testing out an idea, you really do not need to go around registering a business. You could be someone who maybe you're a military spouse, for example, or you're going to school and you're in a place temporarily, maybe taking a course. You're going to be there for 3 months. You just want to run a business. It doesn't really serve you registering a business over there, especially because when you move to wherever you're going to be permanently, you're going to have to register your business as a foreign entity. That's not smart. And then you're paying annual filings in 2 states. Makes no sense. Okay, so the sole proprietorship can really be good, and I think it's always a good place to start, to kind of get your feet wet. But keep in mind, okay, you will be paying that 15.3% of self-employment taxes, and also you still, in addition to that, you still have to pay the income tax on the money that you made. All right. So depending now on your tax bracket, you have to pay the income tax. And then you also, that's federal and state. And you still have to pay the 15.3% of self-employment taxes. Something to think about. Okay. My next entity structure is partnerships. I love partnerships. I think partnerships are incredible. Okay. Now, just as with every entity, they have their pros, they have their cons. But let me tell you, the easiest way of to set up a partnership is where two people come and they greet each other, right? Two people come, shake hands, and they can go into business without any issues whatsoever. All right. Now, with this kind of business partnership, we call it a general partnership. It's like a sole proprietor, two sole proprietors operating business together. All right. Once you have agreed, you're in business, even if you didn't register an entity. I'm going to talk about those that have registered entities, but I'm starting with this because I think sometimes people assume that in order to go into a partnership, you need some kind. No. You can shake hands and start. all right, and you're in business already. So be careful. Don't go shaking hands out there with people without knowing that they've gotten you into a partnership. Now, let's talk about partnerships, okay? When two people come together and they're general partners, like in this case, when it comes to filing taxes, you will normally file something we call a Form 1063. Now, that's called your partnership tax return, 1063. But no, 1065. I'm sorry, guys. You see how I get excited? And I'm just going up. I haven't even touched my notes. I'm just going 1065. So, how do partnerships get taxed? Well, the first thing you have to keep in mind is partnerships are considered pass through entities. I'm sure you've heard this several times, and I'm going to use it again tonight. They're called pass-through entities. Pass-through entities means that the business doesn't pay tax at the business level. That if there's a profit, it's going to flow into the taxes of the owners of the business, and they're going to pay taxes based on their tax brackets. Okay? Which means if me and you went into business and we made a profit, we're in partnership, we made a profit of about $30,000. I'm going to take 15,000 to my taxes. You're going to take your own 15,000. Okay, we're going to file that form 1065. Each person will get a share of their profit or loss. In our case, 15,000 profit on a form called Schedule K1. And we're going to take it to our personal taxes. Now, this is where it's interesting. You and I can be in a partnership, but we pay different amounts of taxes, because you could take your 15,000 and you and your spouse, you're making $400,000 together combined. That's a high tax bracket. You'll be paying more in taxes on that 15,000 compared to me, right? Now, something else I need to add, because we're both general partners, we're also going to pay self-employment taxes. So partnerships owners or partners, right? When they take their share of profit or loss, well, profit in this case, and they take it to their personal taxes. In our example right now, we're focused on general partnerships. General partnership means two of them came in, they shook hands, they started business, they are both involved in running the business actively. Because of that, both of them are going to go ahead and pay self-employment taxes on their profit, and still pay what? Federal and state income taxes on their profit. That's very important that we keep that in mind, you guys. And I'm saying so because if you think of the sole proprietorship, that's pretty much the same taxation. All right. So now a general partnership has its pros and cons. Pros is first because there are multiple people, so we can share ideas, we can bring in more capital because there's more of us, but you're not registered, so it's risky. You're also putting yourself out there and you're risking it. If someone were to sue you guys, they'll come for everything you have. All right. So moving on to the third legal entity, we'll talk about the structure. Now comes those registered entities, and I'll start with the LLC. Okay. An LLC is a limited liability company, and an LLC can be formed by one person or it can have multiple members. All right. When it's multiple members, that's where you can have a partnership, multiple member LLC, which is a partnership. Okay. Now, let's talk about taxation from a single member LLC and a multi-member LLC. Kind of how we just did the sole proprietor and the general partnership. You see how they kind of went line in line, hand in hand. Now we talk about the LLC. The LLC is a great entity structure. Why? It gives you protection. If somebody were to sue you, especially if you can prove beyond reasonable doubt that you did not do anything personally to cause the havoc or whatever it is that happened, they can only come for what you own in the business. Okay. So if we have $30 in our account, they're going to be taking their $30 and moving. Okay. I'm just kidding. I mean, there's more to it, but that just gives you an idea of the fact that they can't really come to you for you personally unless it can be proven that you personally committed some kind of malice or something. Sometimes people are just messy out there. Okay. Now, when it comes to LLCs have their pros and their cons. All right. So when you're a single member LLC, I hate to put it to you, but the IRS treats you exactly the same way that they treat sole proprietors, independent contractors. When you're a single member LLC, they call you a disregarded entity. Disregarded just means we don't have a tax code for you. All right. So when we look at you and your business, we see one. You and your business, you're not separate from each other. We don't file your business separate from you. You and your business, you're one. So when you file your taxes, you're going to report your income and expenses on a Schedule C, with your 1040, which is your personal taxes. So if I were to call the IRS and say, I want to talk about Mr. Selman's taxes, right? Business taxes. I cannot give them your EIN. I will have to give them your social security number because your business is not treated as separate from you. Okay. So sometimes people set up an LLC and they think they get this preferential treatment for taxes. No, unfortunately, you get treated the same way sole proprietors get treated. Now, there's one great thing about the LLC. The LLC gives you flexibility, which is something the other entities don't give you because they are not registered entities. Okay. So when you are an LLC, the IRS gives you the option or the opportunity to choose how you want to be treated for taxes. How crazy is that, right? So as an LLC, you can tell the IRS that I don't want you to see me as a disregarded entity. Okay. Like, look, I have a whole name to carry around these streets. You can't be treating me like a disregarded entity, filing my taxes with my personal taxes. So for that reason, I want you to treat my business as separate from me. Okay. That way you can make what we call an S Corp election or a C Corp election. All right. Now, sometimes people are always surprised when they hear an LLC can make a C Corp election. Yes, you can. Being an S Corp or a C Corp is a way that you can be treated for taxes. Now, there's an entity called C Corp. We're going to talk about that. But the S Corp is an election that you only make with the IRS. And that's you telling the IRS how you want to be treated for taxes. Now, what's the beauty of that? The S Corp is treated separate from you, the owner, and you still have your personal taxes. And so for that reason, because it's treated separate from you, you can actually run payroll on yourself. You can be both an owner and an employee. And so your business can hire you. Your business can pay you a salary, write off the deduction. And when you take any profits that is left, it's called a distribution in an S Corp. You don't have to pay any self-employment taxes on it. So you only pay your standard federal tax and state tax income, state taxes, federal and state taxes on the income that you get from your distribution. So the S Corp is a great way for a business owner to save on self-employment taxes. All right. But the S Corp cannot happen unless you're set up as an LLC. All right. So remember when I talked about the sole proprietor, even the partnership, I forgot to mention, partners cannot run payroll on themselves because partners themselves, they're not treated differently from their business either. That's why they pay self-employment taxes, general partners. All right. So when you become an LLC, if you're a single member LLC, you get treated the same way as a sole proprietor. But at least you have the opportunity to choose how you want to be taxed. All right. So you can choose to be taxed as an S Corp. This is where you can run payroll on yourself and your payroll can become a deduction to your business. This is the time where you get to rent your home to your business because now your business is treated as a separate entity from you. This is when you have things like an accountable plan where you can reimburse yourself for the expenses incurred in your business. You know, all those things. I'm getting excited. Really focus. All right. So now, still on the LLC. So you see, that's what happens if you're a single member LLC. What happens now when you're a multi-member LLC? Pretty similar, you have protection, okay? Multi-member LLCs, they have protection. It's a partnership, but now at least they have protection. Most of these partnerships are set up differently. You have limited liability partnership, you have limited partners with a general partner. They're different. I mean, there are so many new types of partnerships, right? There are professional limited liability companies. There are all kinds of stuff. But then for the most part, most partnerships will have limited partners and at least one general partner. So the limited partners are protected. These people, most of the time, are not involved in the running of the business. Some of them are really just bringing the money. Okay. The general partner is the person who is making the decisions. Like they're in there, they're doing stuff and all of that. Doesn't mean the limited partner cannot be paid to do work in the business. It could, but I'm just saying in this context, the general partner is that person that makes the decisions. And if something were to go wrong, we'll start with that person, right? Now, this is what happens for tax purposes. So think about this when next you want to go into a partnership, okay? If you're a general partner, you do have to pay self-employment taxes on your own share of the profit. But if you're a limited partner, which means you were not involved in running, you were just passive. You just put money and you sit in your corner and you say, let me watch my money. Your income is treated as passive income. If you have a loss, it's treated as passive loss. So your income is not taxed the same way that the general partner's income is taxed. Guys, please, if you can remember this, it will help you so much when you go into partnerships, okay? And it will also help you when if someone is filing the taxes for your partnership, so you can pay attention to that. Okay, so remember, if you're a limited partner, unless you got paid, you guys can have an agreement. There's something called guaranteed payments, where partnerships can have an agreement on how to compensate partners for the time put into work in the business. But just know, if you're not a general partner, you normally don't have to pay self-employment taxes on your income. The general partners do. Okay, partnerships, again, like I mentioned earlier, they are all flow through entities. The profits or losses flow to the tax returns of the individual owners or partners, and then they pay taxes based on their their tax brackets. All right, I hope that helps. Now, I mentioned earlier that partners cannot run payroll on themselves, just the same way single member LLCs cannot run payroll on themselves. But if they choose, let's say they don't want to do the route of a guaranteed payment, they can make an election to be treated as an S corp as well. When they become an S corp, now their business is officially, for the purposes of saving on self-employment taxes, separate from them, and they can be both employees and employers. Versus in the partnership, they are just owners, so they are not treated as separate from their business in the eyes of the IRS. Okay, in this case, if they make an S corp election, they are both owners and they are employees, and so they can be paid for their work, and their business can write off what they are paid as a business deduction, their payroll, and then they get to save on that self-employment taxes. And since they are going to take distributions, their distributions will only be taxed at their federal and state personal income tax rate. Pretty neat, right? So now we've just been talking about the S corp, and something about those partnerships I forgot to mention too is when it comes to partnerships, they can be very tricky when it comes to selling. So when you're setting up partnerships, especially because you have an operating agreement, you want to include clauses on what happens if you want to dissolve, if you want to sell, if you want to bring in another partner. Your operating agreement is really the determining factor here. Of how your partnership is going to, you're going to move on with the partnership. If someone dies, I can't wait to share more. I even have a book coming up, but there's so much when it comes to partnerships. You guys know it's my heart. All right. Before I forget, partnership taxes, S corps partnerships are due March 17th. If you don't have a CPA that gets these entities like I do, you better look for me. I have 15 minutes free meetings on my calendar for inquiries. Make sure that you book one of those. Okay. So all of these entities have already made me kind of mention the S corp. So I'll just talk briefly about the S corp. Like I said, the S corp is not an entity that you register at your state level. It's a tax election, which means it's a means through how you can pay taxes, file and pay taxes. And it has so many benefits, the S corp, but it's not for everybody. And that's why it's always important that before you go making the election to be treated as an S corp, that you have a tax professional that understands your full picture. Okay. So like if I have a client who has 3 kids between the ages of 14 and 8, I would not. I mean, unless they're making a significant amount of money in their business, I would be hesitant to tell them to make an S corp election, just because if they could get their kids involved in the business, that's a significant deduction right there. If they stay filing on their personal taxes as a single member LLC. Okay. But again, all these things vary depending on where a person is in their business, what other things they have going on, and stuff like that. So always talk to someone who gets the full picture. All right. And then our last entity structure here is the C corporation. So the C corporation is an entity structure that you do register at the state, but you could make an election for your LLC to be treated as a C corp for tax purposes. All right. And I know when I teach this, many people always go, but why would anybody want to be treated as a C corp for taxes? Well, let me tell you, there are people who are in all types of income brackets. Okay. And just paying that 21% for them might be a better option. What do I mean by 21%? 21% is a fixed tax rate that C corporations pay. So C corporations are one of your best entity structures if you plan to raise money from the public. All right. And with C corporations, they have a fixed tax rate that they pay on their income, their net income, their profit, pretty much, right? And right now it's 21%. There's been rumors it might go down, not sure about that, but it's 21%. Now, what's the problem with a C corporation? One of the problems is the fact that C corporations have what you call double taxation. Because if you're a part of a C corporation, when you pay taxes on your profit, they're going to distribute dividends. Okay. When you take your dividend home, guess what? Uncle Sam is still going to tax you capital gains tax. So depending on your income bracket, you could also be paying a significant amount of taxes on your profits. All right. So now, if you think about all of these entities, let's just kind of go through each one now. Remember the four things I gave you. Your entity structure is going to determine how much you pay in taxes and how you pay your taxes. It's going to determine how easy it is for you to raise funding. It's going to determine your protection. And last, it's going to also determine how easy it is for you to sell. All right. So let's kind of go through a list of some things that I put here to go through. See, when I'm talking about the entities, I don't even look at anything, but I did have some questions. So the first question I want you to ask anytime you're thinking about setting up a business is, how much liability protection do you need? That's crucial, because if you're in a business that is low risk and you're just testing it out, you may not need to register something at the start. But if you're in a business that is really high risk and has to deal with people, let's say you're in a cleaning business and you're going to go to somebody's house that has, like, this expensive painting, and you never know if something could fall, please definitely consider getting us setting up as an LLC or C Corp. Okay. My next question was, how do you want your business to be taxed? And that's very important, right? Some people are fine having the business pay taxes versus it flowing through to them. Other people want to avoid paying that 15.3% of self-employment taxes as much as they can. And that's where having an S Corp election could be great. Sometimes if you're making a significant amount of money, a C corporation might actually be better, especially if you have so many people kind of involved. Something I needed to mention is with the S Corp, the S Corp election we make, there are certain restrictions on who can be part of an S Corp. One thing I can tell you for sure is if someone is not a US citizen or allowed to be in the US, you cannot be a part of an S Corp, because S Corp taxes, remember, it flows to your personal taxes, which means if you're not allowed to file taxes in the US, you cannot be a part of an S Corp. And an S Corp cannot have more than 100 shareholders. So with those kind of limitations, let's say you have investors from foreign countries, right? Which my next question is, how do you plan to raise funds? If you have investors in different countries in the world, you definitely want to consider a C corporation. That's my question number 3. How do you plan to raise funds? Definitely something to think about. Fourth one is, how flexible do you want to be with your taxation? I'll tell you for sure, the LLC gives you one of the greatest flexibility when it comes to taxation. And interestingly, as a C corporation can also elect to be treated as an S corporation for tax purposes. So definitely things to think about. And then my last one is, are you looking just for simplicity, or do you want to grow? Now, this is important. There are people, and I had to learn this earlier in business. There are people that just want the simple things. Like, they're okay doing, and okay, if I say Mary Kay, and not that I'm picking on anybody who's in Mary Kay, but I'm saying I know people that do Mary Kay, they love it, and they're not trying to become one mighty business, okay? And they love it. There are people who do different types of businesses, and they're so comfortable where they are, and I love that kind of simplicity, because they have so much joy and fulfillment in what they're doing, and they should be allowed to. Now, there are some people who go into business and they want to make a difference, and so they put in all their energy and they just want to kill it. Okay, for someone who is planning to grow, especially if you plan to bring in investors, if you're thinking about raising funds down the road, then it becomes very crucial for you to consider a different entity structure. Like, consider, you can start as an LLC for sure, but definitely a C Corp could be a good one for you if you're certain about the type of business and the type of business that you're going into, that is going to have a really high turnover and might need funding too from multiple sources. Okay, if you're just doing something simple, you're not hurting anybody, you can stay as a sole proprietor. You can get yourself an LLC still. An LLC is always a good way to start, because it has lots of flexibility, but then it gives you that protection. All right. Now, down the road, if you plan to sell your business, just do all you can to avoid being a sole proprietor, because one of the things people think about, especially because I do help people who want to buy businesses, one of the things we always look at is, if the owner was not paying themselves, that means some of the profits that they have is money that could have gone to pay themselves. That's not a good sign. All right. So it's better when you have a separate entity that can show that you are also getting paid, because it lets the person buying your business know that there's potential, a lot of potential for this business. Okay. Guys, I think I've given you too much, and it's not fair to you. For one day, and I'm just yapping and going because I love this stuff. But I would have loved to talk about nonprofits, but they're not for today's topic, they're not part of it. So I hope this is helpful as you are going into business and thinking about how you want to be set up as a business owner. I really pray and hope this is helpful. Tomorrow, I'm going to be talking about funding. Okay, I'll be talking about the different ways you can fund your business and the tax implication of that. I know some of you did not know some of the funds that you seek out, like grants, can be taxable. Yes, I know you didn't know that. And we'll be talking about it tomorrow because it's important so that you know how the different sources of funding are going to impact you tax wise. All right. I can wrap this up now. If there are any questions, I'll be more than happy to answer. I want this brief too because if someone is going to rewatch it, I don't want them staying on the screen forever and going, come on now, give us a break. Thank you all who were able to join me. It's going to be available for you guys to watch. Remember, I do have those complimentary 15 minutes meetings that you can hop on my calendar. It's all for tax inquiry. If you need help with your taxes, don't hesitate to do that. And let me tell you, first of all, I don't need this only for you if you want to become a client. Even if you're not a client and you have tax questions, ask me. Okay, as you can tell, my heart is for the community. So if you have questions, even if someone already did your taxes and you're like, I don't feel I want to ask something, take advantage of it. Okay, for those that are S corps or partnerships, if you don't have a tax person, I will tell you for sure, make sure that you check us out. All right, S corp taxes and partnership taxes are a whole different world. There are so many strategies available for them. There are certain complexities, but if you're just going to someone who's going to input numbers and cannot give you a good guide on how to leverage the tax strategies for you, it's not a good thing. Okay, and something amazing we do at our firm is every S corp or partnership tax that we do, you get a 1 hour complimentary tax planning and strategy meeting that you get to schedule anytime after tax season. How amazing! Which means even if we can't go back and fix anything, guess what? We can put enough things in place or strategies in place for you to win. All right. Sometimes people tell you all these quick strategies on social media, but they don't tell you how to apply it to your business. That's kind of the stuff that we would do. All right. So let me stop here. If there are any questions, I can go ahead and answer. Let's see, because we have our team in the background. If they caught something, if not, I can help off. Right. All righty. Well, the team said I'm good to go. There's no question that I need to answer. I kind of love that. It means everyone got the information and got all they need. I'm hoping so. But if you don't, remember, you can always leverage the 15-minute meeting and hop on the calendar whenever you can to get some clarity. We would love, love, love to give you support as you build, as you navigate this world of entrepreneurship. It's not easy, guys. It's not easy. And trust me, if you're not a CPA or into the tax world, it can be pretty complex. And if you fall in the hands of the wrong person, they can put you in so much trouble, and you have Uncle Sam running behind you for a long time. So make sure you check us out. We're a CPA firm, and so we're open all year long. If anything were to happen, we'll always have your back. We want to make sure that you do things right, and more importantly, make sure that you're leveraging the tax code for your benefit. You're doing it from an informed standpoint. All right. Remember, I said at the start, the tax code is for business owners and real estate investors. But if you do not have the right person to guide you and really educate you on how to leverage these tax strategies, you're going to be leaving money on the table. Okay. So remember, you guys, if you don't have someone, we've got you. The best thing you can do for your business owners, please, is to keep accurate financial records. If I don't leave you anything, please prioritize accurate financial recording. Okay, there are a lot of things we cannot do, when it comes to going back and fixing some of your messes. There are a lot of things we cannot do, but if you have accurate records, hear me out, we can always go back up to 3 years to amend your taxes if someone did them incorrectly. All right, you all be safe. Thank you so much. This was your favorite CPA, Abakwa's finest, Dr. Lily Binglow. And Daddy Yonka's Nyamshilif. Be safe, you guys. Thank you all so, so much. Have a lovely evening. Bye. Bye.